So we're going to talk about the 2025 global outlook that Ayesha prepared for MacroVisor. We want to discuss a little bit more about what we're seeing in a presentation called Shifting Sands here. And Ayesha, you can be the remote control. I'll be the slide deck controller, as it were. So we're just on the first slide here. I'm going to go over to the agenda slide. And why don't you talk a little bit more about the agenda for today's presentation?
Perfect. Yes. Thank you, everyone, for joining us. And so we're going to go through our global outlook. It's not a very comprehensive outlook, but we just want to touch upon a couple of things. Doing an outlook is always difficult. It's always tricky because you're sitting here in November, December, and you're trying to think through everything that could happen for the next 12 months. And often enough, things don't pan out the way you expect it to, right? But we still want to have a look at a couple of things that we think may shape, things to come in 2025. So we'll look at some highlights. First of all, we look at why we call it shifting sands. Then we look at, highlights from 2024. And then, of course, we'll run this macroeconomic outlook through the framework of growth and inflation, and then policy, which is fiscal and monetary. Finally, we'll look at some of our investment strategy outlook, what we think may work in 2025. So moving on to the next slide, the reason we call it shifting sands is because, when we're thinking about 2025, we're faced with a lot of uncertainty. We have this feeling that we actually don't know what may happen. So the uncertainty stems from fiscal policy implementation, the resulting macro effects, and the monetary policy responses to both of that, right? So 2024 came with its own share of surprises, and many of those brought leadership changes around the world, right? The biggest one we saw was in the United States. And this is something that, we thought would happen because people were gunning for change everywhere around the world, right? After the pandemic, everybody was fed up, and everybody wanted a change. But with a change in government, obviously, comes changes in policies. And we don't know how these policies are going to take shape. We are seeing a lot of political turmoil in Europe as well. We saw some upsets in Japan. We've seen a little bit of that in South Africa, in India, so across the world. Now, highlights from 2024, we wanted to actually talk about what we kind of got right and what we got wrong. So that's on the next slide. We did predict that the Fed would start cutting rates, but we were surprised by the jumbo rate cut of 50 basis points. That's not something that was on our bingo card at all, right? We did predict that unemployment would take up to 4.3%, and we're at about 4.2% now. And then we said that, yes, core inflation would come down to below 3% by the first quarter. I think we saw that happen, but unfortunately, it has remained relatively sticky throughout the year. Now, in terms of the Bank of Japan, we predicted they would start hiking and the carry trade would unwind, but we didn't expect the aggressive fallout that the market would see. What we saw in August, early August, if I'm not wrong, August 5th, I think was the date.
Yes.
And then, of course, we did predict, what would happen in the Euro area and the UK, most of which we got right. China, however, was a wild card coming in. We had hoped that we'd see stimulus measures. There's been a drip feed of some measures. Yes, they did release quite a substantial amount, but that was again directed only towards the local government, which in and of itself is not a bad thing because is a problem that needs to be sorted. But having said that, I think it still disappointed the market because it wasn't directed towards the consumer or directly towards the property market, which is on everybody's radar as being the most problematic area. So All in all, yes, we got a few things right, but we did get a few things wrong as well. And that's how it is when you predict anything. So let's see what we get right for the coming year. So, for the coming year, as I said, we want to look at things through this framework of growth and inflation, and then, of course, policy. So, moving on to growth and inflation, what we think for 2025 is that economic growth will moderate to a certain extent. Now, we don't expect this slowdown to be recessionary, so we don't expect a global recession. However, we do expect relative slowdown to what we've been seeing in 23 and 24, and particularly in the US as well. Again, we think that the Fed may be able to pull off a soft landing, but we don't expect a recession. Now, adding to these, of course, is the potential effects of the US tariff policies and various other policies that we may see from the new administration. But even before this formal implementation, the tariffs could actually impact market sentiment, and we've been seeing that, right? So what we've been seeing is the Trump trades, we've been seeing the reshoring trade, and therefore once we start to understand a little bit more about how these tariffs will take place, we will see the impact in terms of stocks, in terms of global markets, and that may happen even if the tariffs are not implemented. By the time this implementation takes place, we think it might, or any implementation, it might go into probably the last quarter or even into 2026, because remember, implementing these kind of things is not always easy. Last time, I think it took about 9 months to 11 months from the first discussion to anything actually being implemented. Now, this kind of complicates the situation for everyone, and it also makes the US dollar relatively stronger, which means other currencies get hit, and therefore it's going to be difficult for policymakers to also kind of navigate this. Now, moving on, we want to look at a couple of the countries in terms of growth and inflation. We want to start off with the US. So for the US, we think stagflation is a very real concern. We think, as we said, growth was slow. Inflation, however, remains sticky and may probably even increase towards the end of the year, end of 2025. However, consumer and corporate balance sheets do remain relatively strong, and debt burden ratios are still relatively low. Even the labor market we've been seeing has remained quite resilient. There was a small window of time when we thought that the labor market was weakening significantly, but it's still proven to be quite more resilient than expected. Now, these proposed tariffs, of course, will weigh on inflation, but the most important thing we think is the tighter immigration policies. So the tighter immigration policies will sort of rein back labor supply, and that could push up wages, right? So what we'll be seeing is higher costs and possibly wage inflation. Don't forget, immigration was a big factor in actually balancing the labor market in 23 and 24. So bringing down those wage levels, it was largely a function of immigration, because there were labor shortages, and that was filled by immigrants coming into the country. Now, by late 2025, we think, therefore, we might see another bout of inflation coming back, not to the levels that we saw before. It's not going to happen that way, but relative to what we've been seeing in 2024, we think we might see a little bit of a spike, and that could sort of keep inflation on the stickier side. So that's the US. But Stagflation is not only a problem in the US. Today was the ECB meeting, and I was listening to President Lagarde. And what it seemed like was inflation is front and center on her mind as well. And from what I gathered is, there's, again, she used the word uncertainty quite a bit as well, just like, we're feeling this uncertainty for next year. And part of that has to do with, these different policies being put in place. And so therefore, we think that growth, of course, is a concern in Europe. But at the same time, inflation seems still to be on their mind, right? Having said that, today the ECB has dropped their restrictive policy wording from their statement. And that's exactly what we thought may happen going into 2025. Basically, what we're thinking is inflation starts to come down to target levels, so the 2% level, and growth as well moderates. And that's what the staff projections are also showing today, that they cut their growth projections and they cut their inflation projections. However, they still think that inflation will be above target in 2025. But having said that, they're saying 2.1%, which is not major, right? Growth, on the other hand, is a bigger concern. Now, one of the other concerns that President Lagarde talked about is the fiscal policy, and we'll talk about that in a little bit. But having said all of this, what we think is there could be the possibility of stagflation even in Europe. So this is something that, we need to bear in mind. Now, for the UK, we think, again, we have an issue with growth there. Although growth has been stronger than the euro area, we still think fiscal. So with the new government, we have a new budget, we have new fiscal policies, and all of this is sort of driving spending over there, which may in turn drive inflation. And this is putting, pressure on the Bank of England as to how fast they can cut rates. For the UK, we think there will be, again, quite a bit of uncertainty, and this time driven from their own people, so not externally, but internally, right? So between the fiscal policies and monetary policies. For the rest of the world, it's more interdependent, let's say, but for the UK, not so much. For the UK, it seems to be more driven by their internal policies. Now, moving on to Asia, we have Japan and we have China. So in Japan, we think that growth still remains positive. They have expressed some concerns, though, as to whether inflation will sort of reach that 2% or be stable at that 2% target. We think the fiscal impulse could actually maintain the 2% target. The most important thing to remember in terms of inflation and growth in Japan will be the wage growth, right? So wage growth has improved considerably over the last year. But we need to they need to make sure that this wage growth stays on an upward trajectory. If that happens, then coupled with the fiscal policies, we think consumption can actually drive GDP growth, keep it positive, and therefore have quite a stable and strong economy, contrary to what they've had for the last 40 years, right? So there is a window of opportunity here for Japan to sort of turn things around. And they are seemingly are turning things around. China, on the other hand, is going the other way. So today there was a note from Goldman Sachs where, they're talking about China becoming Japan from 30 years ago or 40 years ago, whatever the case may be. And they're not the first one to say it. I've heard this being said quite a few times. Unfortunately, the debt burden there is still relatively huge. And this is why when we talked about policies in general, And I said that, their policies directed towards the local government is not the wrong thing. There is a looming debt crisis for these local government funding vehicles. And so I think what they've done is they've put a band-aid on what's most, what they think has the biggest crisis situation or most imminent threat, let's say. But growth, I think, still continues to moderate in China. So until and unless the Chinese government actually pushes through with serious fiscal and monetary policies, not just for the local government, but for consumption, for the property market, we're likely to see them fall below their 5% target growth. And then, of course, we have the issue of deflation. So they continue to see deflation there. Their crisis of confidence continues. This chart clearly shows that their consumer confidence is in the dumps, as is housing prices. So people are not spending, and because they don't have confidence in the economy. Despite all these measures being talked about over the last 2 to 3 days, we're still seeing yields fall to historic levels, meaning people are worried about growth and are pricing in lower growth going forward. We then turn our attention to policy. So in terms of policy, we obviously have fiscal policy, which is government spending and how the government wants to spend their money, what they want to do in terms of revenues, taxes. And then we have monetary policy, which are the central banks. So in terms of fiscal policy, for the last 2 years, we've been seeing fiscal dominance, right? So government spending has been one of the largest line items for most of the countries around the world. We think that fiscal impulse will fade, and in fact, it should fade. Even today, President Lagarde was talking about, fiscal consolidation across Europe, and that's something that's much needed everywhere. We'll see how that pans out. We think there may be some consolidation because it's about time governments start thinking about that. But headline fiscal deficits still remain a problem because of the large interest burden, right? So as the central bank increased rates, the interest payments actually became a huge burden, and they may actually overtake most of, other government spending in the next few years. At least that's the projection from CBO for the US. Now, in terms of monetary policy, I think in 2024, we kind of saw a more synchronized situation where most countries were easing, right? So everybody hiked to battle inflation. And then 2024 was the year when, maybe not all at the same time, but most countries started looking at the easing bias, and most countries started cutting rates. However, next year, we think that's not going to be the situation, and we think central banks will start to, be out of step, right? So they're not going to be dancing in line with each other. And this is mainly because of the different fiscal policies. So in terms of the Fed, we think the Fed will probably go one way, the ECB will go another, and then emerging markets obviously will go a different way. We look at we have, a list of central banks and our projections for them, and we'll look at that in a little bit. But before we move on to that, we wanted to look a little bit at the US policies, because this is now the most talked about and something that everybody says every time the US sneezes, the whole world catches a cold. And it's like that, right? So US policies do affect the world, and some of these policies actually affect the world even more directly. So so this is like a slide for you to probably read later, but we talked a little bit about immigration. We talked about tariffs, which might lead to slower growth. Now, tax cuts could have a drag on the fiscal debt, but at the same time, this could also boost company revenues, right? So that could be positive for the market, because we think for companies, tariffs wage costs could start to put pressure on their bottom line. So the tax cuts could actually help in offsetting some of those cost pressures. So it remains to be seen how far this is going to work out. But at the same time, it's something that, can sort of balance the situation a little bit. So it's not going to be as bad, right? And then, of course, we could have there's talks of deregulation, which could help boost, particularly the financial and the energy sectors. We know all these. But what's important to note is this red sweep that we have, it could actually help with the debt ceiling issue. So over the last couple of years, we know this drama that we've been having about the debt ceiling. Now, there is a narrow majority in the House, so there could still be challenges. But at the same time, we think that it might become slightly easier for the debt ceiling issue to be tackled. The other thing that we should be looking at for next year is the Treasury refunding, right? So as we start to, as the central bank starts to cut rates, we want to see whether the Treasury moves on to longer tenors. We're also going to have a new Treasury Secretary, so we'll need to see what the policies are going to be for next year. Maybe it's not going to be all issuances at the short end. But overall, we think long-term rates are going to be pushed higher, and that's something to be, mindful of. We then look at fiscal policies for, a few of the major countries across the world. So in the euro area, we talked about fiscal consolidation, and that needs to take place. However, we think Germany might continue to spend just because, their economy is ailing, manufacturing is, really in the dumps there. In terms of the UK, we've talked about the fiscal policy again or the fiscal budget being spending. So that again could be an issue for, the Bank of England, but it could be good for stocks actually. Japan, we said the fiscal impulse will continue. And for China, again, it's a question mark. So we have some details here. Feel free to go through them later. We will make the, slide deck available to everyone. Now, in terms of central bank policies, so this is where I think things start to get a little bit interesting, because it's always interesting to kind of project how many cuts every central bank will have. Obviously, we could be totally wrong, but let's do the exercise anyway, right? So for the Fed, if the Fed, cuts rates in December, so next week, we think we might see only 2 cuts next year, and possibly a third in the second half if inflation moderates. However, if inflation starts to pick up, we might only get 2 cuts from the Fed. Now, what would be more interesting to note is that we may actually start to see the long-term rate remain high or higher, projected to remain higher. So terminal rates basically could move up, which means that the US will have higher rates overall, even in the long term. That's just something we think may happen. As for the Bank of England, we think 3 cuts, 2 in the first half, 1 in the second half. The ECB, we think, will cut 4 times, mainly because of the pressures on growth. Yes, inflation is a concern, but we think that growth is a bigger concern there, and therefore, they'll probably cut 4 times. So that will bring the rate down to 2% by the end of 2025. For the Bank of Japan, now it depends on whether, again, they're going to hike next week or not. So now there's a little bit of a question mark as to whether the hike will take place in December or January. So let's say even if it does take place in January, that would actually be a 2024 hike just pushed out by a month. So if that's the case, then we still see 2 more hikes from the Bank of Japan in 2025. However, we think that the first hike would be after the spring wage negotiation to see how things pan out, how robust wage growth may be. and then maybe a second one in the second half of 2025. Now, PBOC, so China, completely uncertain. They had this recent meeting and they talked about more aggressive monetary policy easing or an easier stance. Still remains to be seen how that works out and what that looks like in terms of actual rate cuts. RBA. So RBA is interesting. We projected the first cut to take place in the first quarter and 3 cuts for the rest of the year. However, today there's been some adjustment to that view, and most analysts are now thinking the first cut may come in May. Having said that, I still think that we might get the first cut in the first quarter simply because the GDP numbers are looking weak, right? And that is a concern. So I think inflation has moderated there quite a bit, and I think they can start to cut in the first quarter, barring any further, inflation spikes or surprises. Now, India, on the other hand, has held rates for the entire 2024, which is quite surprising, but again, not so surprising given their inflation has been going up again. So we think India might cut maybe 3 times next year, with the first one in April and then 2 more over the course of the year. But it still depends on, how their inflation is panning out, because growth still remains relatively strong. Growth is slowing a little bit, but it's obviously much higher than most other countries. So remains to be seen whether they actually do 3 cuts, might be 2 as well. And then finally, we have the Bank of Canada. So the Bank of Canada has been on a roll with their rate cuts, very aggressive. We think they might stop cutting in the first quarter and then maybe hold for the remainder of the year. We'll see how that works out, but this is just the view. Sorry, I just wanted to have a sip of water. Okay, so finally, we want to look at our investment outlook, right? So in terms of our investment outlook, we've looked at the US, we've looked at various countries, and then of course we've looked at some of the commodities. Now, for the US, I'm not going to go through all of this, but what we think is US exceptionalism can continue. And, we need to see earnings growth, we need to see lower 10-year yields, which may or may not happen. But we still think GDP growth will be stable. So slowing, but still stable, still relatively high, let's say. And we think liquidity will also increase in the sense that the Fed will actually stop their QT sometime in 2025. So again, we have conditions that will foster, growth for companies and for markets to go higher. We've given a list of kind of where we want to focus on in terms of being overweight. Some of that has to do with, the policies, the new policies, which is, stocks that can benefit from reshoring, less exposed to wage growth, less exposed to the stronger dollar, and more exposed to possibly higher yields. And then we look at some of the other countries very briefly. So for the euro area, we still want to remain underweight. Again, it's a growth issue over there. There is also some political turmoil. We just think that for now, remaining underweight for the euro area is like the right thing to do. We still haven't seen consumer demand pick up there. Global demand is also, faulty when it comes to, European manufacturing. So still subdued levels of activity. For the UK, we remain neutral. This is overall. Now, obviously, sitting here and predicting for the whole year is quite difficult. So we do look at things on a weekly basis, on a quarterly basis, in terms of ideas, in terms of going long or short. And that makes more sense. But this is sort of an overall view as to how the year sort of plays out. For Japan, we still remain neutral. I think, the stronger yen still weighs on companies. And the stronger yen will actually weigh on export companies, which are some of the bigger companies, right? And so, we should shift our focus to some of the smaller companies because we expect consumption to pick up and domestic consumption to pick up. So that could sort of help with some of the smaller to mid-sized companies. Australia, if the RBA starts cutting, I think going overweight Australia might be a good idea. And then in terms of emerging markets, 2024 was actually quite a good year for emerging markets. But for 2025, we think things will become very challenging in the emerging markets, right? So with a higher dollar, with the Fed not cutting as drastically, we think that emerging markets will have to slow down on their rate cuts as well. A higher dollar means higher commodity prices. It's just going to weigh on these countries. Their currencies will start to depreciate. Inflation will come back into their country. So I think there's a very challenging path ahead for emerging markets. And therefore, we want to be underweight to neutral when it comes to the emerging market. And then we have bonds. So in terms of bonds, we want to be underweight government bonds. We do like investment grade bonds for corporates because we think there will be strength in corporates. Earnings growth is still, positive and increasing. So investment grade corporates are a good place, or investment grade bonds are a good place to be. Again, for the same reasons that we talked about, being underweight emerging market bonds actually is a good idea. So that's in terms of bonds. We still like medium-term tenors instead of longer-term tenors. That's for the fixed income space. Now, in terms of commodities, for crude oil, our target, or rather our forecast, is for 64 to 69 per barrel on WTI, which translates to about 69 to 74 per barrel on Brent. Now, I know it's quite a wide range, but oil can be volatile, right? So giving you one price is quite difficult, but we think oil remains under pressure for a couple of reasons, right? So we might see sporadic increases because of geopolitical tensions, but we still think that the market is oversupplied. Yes, the OPEC Plus said that they will keep production cuts in place, but this is because they're seeing the same thing that we're talking about, right? The market is oversupplied and demand is subdued, particularly when it comes to China. But when we're looking at the rest of the world as well, demand has not picked up as expected. And then finally, we have these deregulation issues and, President Trump coming into office and saying, drill, baby, drill. So that's a wild card. Nobody knows what he means in terms of policies there, right? And what kind of policies will come into place and how quickly that will translate into oil prices. So everybody is a little uncertain when it comes to the crude oil situation. But for now, what we understand is there's more supply than there is demand. And therefore, we think that oil prices can remain under pressure, right? So downward. Lower oil prices. And then gold, of course, is the exception. We saw gold spike last year. We still remain very bullish on gold. I think Mayhem has a target of 3,000 on gold, and that's actually a good target, right? And so we think gold can still go higher, let's say. Now, in terms of other metals, we are less bullish again for the demand situation, right? So again, a lot of uncertainty, but most of the demand starts to come out of, let's say, China. And if China is not demanding, copper and these other metals, then obviously there will be pressure on prices. Now, we could start to get more bullish if we see how the reshoring and manufacturing initiatives play out in the US, because then there will be maybe this resurgence in demand for materials, right, which include metals. So that's something that remains to be seen, but we'll have to play that, either month by month or quarter by quarter. Now, in terms of agriculture, finally, so these trade wars, I think they're going to put a lot of pressure on agricultural prices, right? So especially between the US and China. And it will definitely affect US crop prices quite a bit, particularly soybeans and corn. There will be reduced export demand. And so these farmers will probably supply this more domestically, and that could sort of push prices down even more. So basically, again, supply will exceed demand, and therefore prices will go down. Now, President Trump has historically given direct subsidies to farmers, so this again remains to be seen whether that will be done again. If that happens, then we might see prices at least hold in there. We still don't think prices will start to shoot up, but we think that, prices will hold. However, what's, you know, challenging for the US could actually be beneficial for the rest of the world. So other countries can start, supplying this agriculture, and most likely prices will start to go up elsewhere. So basically, the bottom line is when you have trade wars, there's always upward, downward pressure on prices. Sometimes upward, sometimes downward. It depends on where the forces are coming from, which is why when I look at anything in the macroeconomic environment, I look at it through the eyes of supply and demand, right? So when you look at who's supplying and who's demanding, it starts to become a little bit more clearer. But what we do know in general, trade wars basically restrict trade. They put pressure on growth. And so therefore, we think growth will start to slow down next year. And then they also put upward pressure on prices in general. And so we think inflation can also remain sticky for next year. So everything considered, I think it's a challenging path ahead particularly for the central banks in determining how they need to change policy, because they probably thought about one, certain path for policy, and then that needs to be changed now, considering everything that may happen. And we'll see some of that next week when the Fed releases their summary of economic projections. I suspect they will change how many rate cuts. They had projected 4 rate cuts. I think they will change that to 3. Changing it down to 2 would be too drastic. So my view is maybe they change it down to 3 for now. And with that, we're done. So if you want to know more about our work, you're welcome to reach out to us.
Thank you, Ayesha. That was awesome. Really appreciate sharing your thoughts about what's going to happen in the year ahead. And, I think we can pause for a moment here, see if we have any questions from folks. So if you're out there watching, listening, if you have a question for us, post it out there. I'll be looking at the chats. I know we're in a couple of them right now. So we have this going on Discord, YouTube, and Twitter, or X as it were. So again, if you have a question for us about what we've just presented, feel free to put it in the chat rooms, and we're more than happy to address those. So one somewhat unrelated question, but as people gather their thoughts, I figure may as well address this. Loki asks, what are your thoughts on Amazon making chips that directly compete with NVIDIA? Are they even powerful enough? So the Trainium 2 chips that Amazon is making, I think, are very interesting because they're one of those companies that can sort of vertically integrate. They have the largest publicly available leased cloud. Microsoft has the largest total cloud, but Amazon has the largest cloud that they lease out to the public, and Trainium will be available through that offering. So unlike NVIDIA, who has a much smaller cloud offering, much more specialized, and tends to help to sort of build partnerships in that ecosystem with companies like CoreWeave, Amazon is actually trying to do more vertical integration. They're trying to create a bit of a challenger for NVIDIA here with Trainium, because the big money in semiconductors and AI right now is more on the training than inference side. if you think about it. It's much more computationally intensive to train models. And so what Amazon's hoping to do is get a piece of that pie. Now, the big, I would say, challenge that they face is that it doesn't natively work in the CUDA ecosystem, as I understand it. So there still is a whole lot of code built for training, built for, basically scaling up these large language models and image generation and video generation models that runs natively on CUDA. So maybe Amazon is starting to work more towards building a bridge. I do think they can compete there because of the sheer scale of their cloud offering, because they're going to put this front and center in, the minds of engineers and decision makers so that they can decide whether they want to look at augmenting their workload and potentially saving some money if they're outsourcing their training computational workload to the cloud rather than building their own in-house capabilities. So hopefully that is helpful. Loki also goes on to say, well done, Miss Ayesha, on the carry trade prediction. I didn't even think it was predictable, but you nailed it. So a little bit of feedback from the audience as well.
Thank you. So our global, it was quite interesting when I was watching, like going through our slide deck for 2024. um, I was talking to Mayhem as well at the same time, and I kept on telling him. I said, "Oh, we caught this, and we caught that, and we caught this." So we were actually quite spot on about a couple of things. But yeah, but the fallout is not something that we expected. So I don't think anyone expected it. Otherwise, we wouldn't have seen the blow up that we did.
Yeah, that's one of those sort of cautionary tales of what happens in a world where at least some trading desks are highly leveraged. They're used to this negative or zero interest rate policy for such a long period of time that even a small shift in rates can cause some degree of disorderly deleveraging, and then it starts to spread to other trading desks. So it sort of started off with Japan and their trading houses, then moved over to South Korea, and then sort of spread around to Europe and the United States. And you had this very kind of short-lived volatility event based on, to some degree, on that deleveraging because of that unexpected rate increase by the Bank of Japan. So it's always interesting to see how these things play out, because these are those sort of exogenous risks that you can't necessarily forecast for in advance in terms of exactly how it's expressed in the markets. Sometimes you can have something like that play out and it's a much lower grade volatility event. And then on the other side of the extreme, you have it maybe last for days or weeks. So in this sense, it was basically a one-day event. And it was very interesting because the Bank of Japan actually came out after that and said, I think it was one of the deputies, but basically came out and said, you know what, in the future, we're just not going to hike into market volatility. And it's almost like telling the market, here are the keys to the car. If you want to drive, if you want to decide policy, you're in control now. Because all you have to do, if you don't want that hike that we'll broadcast in advance, is get real volatile up into the meeting and we won't hike. So that actually helped to salve the markets because they were kind of expecting the unexpected, that maybe the Bank of Japan could come out and do some of these more, I would say unanticipated types of tightening events, which this one was. People expected some change to the rate of yield curve management, if you even want to call it, or at least quantitative easing that the Bank of Japan is doing. That was expected in advance, but the hike was not, and that caught a lot of participants off guard. So the Bank of Japan deputy basically saying, oh, sorry about that, guys. That won't happen again. If you're not happy with the policy path, just express that view by making equities and rates trade with more volatility. We'll receive that message, and we won't change our policy path as we were hoping to do. Extraordinary. Not sure anything quite like that in a developed country central bank has ever happened before, at least not to my knowledge. So that's where, people like to say, oh, the Fed watches the stock market and they make their decisions based on the stock market. I mean, that's a much more tenuous relationship. Maybe it's more true in the current regime at the central bank that we have in the United States than it's been in the past. But in Japan, it was all front and center for the entire world to see. There was no uncertainty that the market literally controls the policy path. And they even said it. They said the quiet part out loud. And so Rando asks, what would you recommend to do if we see stagflation? And Ayesha, you were talking about it specifically within the context of the United States, but we also know that the vast majority of investors are focused in US based assets. We can see it with the flows, the positioning, and just the performance over time. So, what would your thought be if we do see stagflation in the United States? And for folks out there that aren't familiar with what this means, it means inflation rising, growth slowing. What would be the sort of assets that you would want to consider investing in?
So we've actually seen a bout of inflation, right? So what we think is that inflation may stay sticky or may start to rise again. And so if that happens, um, you want to be in inflation beneficiaries, which are like consumer staples and I'm drawing a blank. But yes, most of the companies that could benefit from inflation. Now, the growth slowdown, again, I want to reiterate this. It's not going to be a massive slowdown in growth because we will still have fiscal spending, right? And I think, um, let me sum it up this way: follow the money. So I think fiscal spending will be directed towards certain industries, right? And that's probably our best bet. So we look at companies where fiscal spending is being directed, and then so certain industrials and manufacturing. So many of the old economy stocks. Then we can look at financials because financials will benefit from higher long-term rates, insurance, utilities. In terms of tech, um, so tech is not going to be based on stagflation but rather or spending to a certain extent spending. But for tech, what I would say is I think things are going to get less boring in tech. What we saw for the last almost 2 years was just 7 companies, right? And it was extremely boring. I mean, that's the only way I can put it. It was only about these 7 companies. Every morning you wake up and look at what these 7 companies are doing, and that was about it. But I think what would start to become interesting is how this tech broadens out now. So we saw some beneficiaries in terms of utilities. I think we will start to see more beneficiary. We saw some in terms of cybersecurity as well. Now we need to see that broaden out a little bit more. So I think, Mayhem, you can add some more color here. But in terms of tech, I would like to see the peripheral tech companies start to pick up versus just these 7.
Yeah, absolutely. And some great thoughts there, Aisha. Happy to add some of my own. So in an environment of stagflation, what I'd be looking for is value over growth as a trade. It could be expressed as a pair trade, or it could be just a straight long mid cap and large cap value. Growth has outperformed value, but it tends to outperform value in environments of disinflation or low and controlled inflation and overall benefits from lower rates. If you start to see inflation pick up and growth slow down, I think the companies that are stronger producers of free cash flow with clean balance sheets, and they're going to be in sectors, like Aisha was talking about, consumer staples could be one, financials potentially, although may want to stay away from regional banks if they still have a lot of that concentration in some of that longer duration paper, because rising rates there could put them back into some degree of pressure again. But on the other side of it, I also would say that we probably want to look at some of the short-term fixed income opportunities, because in an environment of slowing growth but rising inflation, you still have rates generally stay elevated. You wouldn't necessarily want to get involved with anything on the longer end of duration because those areas would demand a better term premium. So that would mean rates start to push up, your longer duration bonds start to come under pressure. But on the other side of it, it means I'd want to have more exposure into things like bills, because with those, you're holding them to maturity, right? You're not going to typically buy a bill and then sell it. And even if you do sell it, any kind of capital depreciation that happens because of rising rates is de minimis compared to the long end, which is just much more volatile and moves a lot more with prevailing thoughts about where the economy is going and where inflation's going. So for the fixed income side of the portfolio, I'd be much more interested in just continuing to have a ladder approach in various tenors of bills, because you may benefit if rates start to rise on the short end, but at the very least, you're keeping your capital preserved. You're also not tying it up for too long, right? So if you see some sort of opportunity arise in an environment of like stagflation, a lot of people aren't used to it, so you could get more volatility in risk assets. And sometimes that volatility leads to episodes of selling that create opportunities. The nice thing about having some exposure in bills is that then you have that cash ready to deploy in pretty short order if those opportunities start to present themselves. So those would be some of the things I'd look at. The other would be continuing to gain some kind of exposure to areas that benefit in the commodity complex. If there is stagflation, then there are likely to be areas of commodities that are outperforming, right? Because if you're looking at an environment of prices rising more than we want to see them rise, usually a part of that's going to be on the raw materials side. Maybe it could be parts of the energy or metals complex. It really all depends on how it plays out and if it plays out. But if it did, I would want to continue to look at exposure into those commodities that are outperforming. And so how do you qualify that relative strength? Well, take a commodity. Let's say it's copper or silver or natural gas, whatever you want to look at. And you just kind of want to screen these one by one and do a ratio chart between that commodity and a broader commodity index. And what you're doing with that ratio chart is you're seeing over various time periods, is it outperforming the broader commodity index? And if it is, then you may want to buy and start to build a momentum strategy based on that relative strength. So that would be how I'd qualify the commodity plays. We'll also see the beneficiaries. It could be, as Ayesha was talking about, as a result of these trade wars. There could be certain commodities that gain some degree of price appreciation because of that imbalance between supply and demand that any kind of tariffs may cause if they're put on them. And then in terms of the tech space, I still believe that some of the better run cybersecurity players and overall SaaS players have a role here as potential areas in the portfolio to gain exposure to this innovation cycle that's still largely early innings, but again, not necessarily overly focusing on the Mag 7. So I do like the Hack ETF, HACK. I think that's an interesting area. It has a strong uptrend that it's benefited from. It had a little bit of turbulence recently. If you caught my Navigating the Markets from Tuesday, I said I'd like to nibble as we see it kind of come down a little bit. There's a number of different ETFs that I like for that as well. QQQE is another one that I would be interested in gaining exposure to because it's the equal weighted NASDAQ 100. So instead of buying the QQQ ETF, where about 40 cents out of every dollar that you put in goes to like the top 10 stocks, you can buy QQQE and every single dollar you put in is divided evenly among those 100 components. Another example of that I have a similar thesis on is RSP versus SPY. And that is the equal weighted S&P 500 ETF, where when you put a dollar in, it's divided evenly among the 500 components versus SPY, where you're getting about 35% in the top 10, right? So you can see there's a bit of concentration risk. And the reason I mention that, there's nothing ostensibly wrong with QQQ or SPY. They've done very well. But I do think we see in an environment where some of the larger companies are expected to see their growth slow down a bit, not go negative, but slow down, and where some of these other companies and sectors and industries are expected to see their growth start to pick up again, we could see a little bit of a handing off. We could see an environment where the equal weighted indices perform better than the market cap weighted indices. It's also, as people like to say, a bit more of a stock picker's market. Those industries, sectors, and individual companies that are outperforming the broader aggregates of revenue and earnings growth should also outperform the broader market going into next year. So that would be my sort of, take on how I would handle stagflation. And the risk to qualify that it's actually happening would be to get sequential prints of inflation that are starting to accelerate again at the same time that you're seeing signs of economic growth slow down. So more job market losses, a slowdown in real retail sales, not just the headline number. Important to qualify that the headline number is nominal. So it doesn't really tell you the full picture. But if you go to Fred or other aggregators of econometric data, you can look at real retail data and you can look at those sales over time and see, are they starting to fall, or at least are they just going flat? And that's a sense that there's not really a lot of growth happening there. We can look at broader aggregates like GDP data. But at the end of the day, you want to see, if you're going to qualify that stagflation is playing out, some degree of acceleration in inflation and deceleration in growth happening simultaneously over sequential prints of data, right? And you'll see that shift off in the market as well as to where people want to express their view that they want to have some degree of risk exposure and where they're going to want to take risk off. So you'll also be able to gauge relative strength versus relative weakness on a momentum basis by looking at things like SPY versus different sectors, industries, individual companies, and seeing where that capital is flowing into and out of to gauge it via relative strength and relative weakness over timeframes like weeks and months. So hopefully that helps, Rando. I know it's a long answer, but it's because, this is an environment that is different than perhaps what we've been used to. And Loki asks, what's the probabilities of financial repression and yield curve control in the future? That's an interesting question. Ayesha, do you have thoughts on that? I have some as well.
In the US?
I believe that is what he's asking, yeah.
I don't see yield curve control happening in the US, honestly. I think it's going to be too much of a controversial matter if they actually start to do that. What do you think?
I think that we sort of saw it in a completely different way. It wasn't yield curve control, but it was issuance control to affect outcomes on the yield curve. So I think if we do see any potential for something like that happening, we've already got the manual from Yellen's Treasury as to how you can sequence issuance in different sizes, pull more towards the front end to try to keep the long end from running higher. And I think there was a motivation for that. I think one was keep the markets liquid, but two was make sure the vulnerable banks don't start blowing up again because, obviously they have a lot of exposure into these longer duration assets, whether it's mortgage-backed securities or treasuries or otherwise, that would come under pressure if, say, the 10-year got over 5%, mortgages got well in excess of 8%, and so forth. That would imply that their book was under pressure. So I agree with Ayesha. I don't think we're going to see anything officially called yield curve control. That seems very unlikely. And really the Fed doesn't necessarily have the elasticity of balance sheet to accomplish something like that without creating a lot of distortions. So I think in the future, it would be something that's more accomplished by treasury issuance control. And we've already seen, sort of proof of concept that they can do that and they can try to effectuate outcomes by doing so. And folks, if you haven't checked out MacroVisor, you can sign up. There is a free weekly newsletter, the weekend edition that Ayesha writes up, which I think everyone should be reading over the weekend to prepare for the week ahead. So definitely check it out just for that. And then if you like what you see, sign up for the premium where you get daily breakfast bites, our weekly MacroVisor dashboard, and more. All right, we have a question coming in on the Discord here. How do you think the incoming administration's policies will influence companies' decision-making, primarily the Magnificent Seven, and how will these trickle down into the broader economy?
So I think we need to take them maybe one by one. So there are four broad pillars of the policies, right? So we looked at them briefly. So we have taxes, we have immigration, we have deregulation, and then we have the tariffs. So looking at the tariffs and immigration, we talked about, costs going up, right? So companies need to sort of understand that some of their costs may be going up. Now, having said that, I think when it comes to tariffs, there will be a lot of exemptions that will be negotiated because obviously the idea of putting tariffs is to, let's say, tax the rest of the world and not the US companies, right? So if US companies see their costs going up, that's not, let's say, the end goal of the tariffs. So therefore, I think there will be exemptions negotiated. But in general, we can say that costs will start to rise. On the other hand, for immigration and tariffs, on the other hand, you have the tax cuts, which could sort of balance out those costs, as I mentioned. And of course, deregulation will mean, again, those exemptions, not just for the tariffs, but many of the other exemptions will come into place. Now, before the elections, we saw a lot of companies sort of keep capital on the sidelines and not deploy them because they were uncertain of what may happen. Now, over the last couple of weeks, we've already been seeing various, measures and reports that capital is already being deployed into initiatives. One thing that we did, which you can see as well, is the ISM manufacturing or the PMI numbers for manufacturing, which were quite strong, right? And that's sort of part of this initiative as well. So I think companies will want to see exactly how these policies are going to be put in place, whether they fall under these exemptions or they don't. And therefore, they will have to make their capital allocation decisions accordingly. I think the overarching issue that companies need to bear in mind, though, is not just the policies, but the fact that we might actually have rates that remain higher. Remember, 24 and 25 will be, or 24 was to a certain extent, but 2025 will be a year of significant maturity walls, right? Because if you think that a lot of these companies refinance their debt in 2020, 5-year debt coming due in 2025, right? And so therefore, I think that's one of the bigger issues that companies need to bear in mind, that if rates remain upward sticky, then how they need to manage their capital allocation decisions. Now, in terms of the Mag 7, I think I'll leave that to Mayhem.
That's a really, really great analysis, Aisha. I appreciate that. So one other bit of nuance that I think is interesting to discuss also is the H-1B visa situation, which really has a big impact on tech. There's been a lot of companies that are very much, I would say, leaning into a heavily flawed program to avoid hiring in the US. This has actually led to some lawsuits that are starting to come out with some of the bigger companies that are involved with outsourcing. So this is an area where I would imagine if Trump is serious about bringing jobs home and trying to stimulate the economy and all the dynamism that comes with, that there would be a bit of a crackdown here. The reason I mention that is it would increase some of the costs that these companies would incur when bringing on new talent. It could also lead to, some degree of wanting to hire people in advance of that policy coming into effect if it's even discussed, right? So with tech, labor tends to swing like a pendulum, and it's often true in other industries, but it seems to happen in shorter and more volatile cycles in tech. So we saw in late 2020 to early 2022, there was this sort of over-hiring binge. Companies were just hiring to prevent other people from being able to hire the same people. Like, it was hoarding of mind share that was happening. And then it very much and somewhat violently went the other way when we started to see companies focusing more on cash efficiency. In the latter part of 2022, there was much broader concern about basically cost efficiency across the board. So we saw companies laying people off, doing things to increase attrition, like forcing back to office movements, things like that. So the reason I bring up H-1B is because we've seen so much outsourcing, especially in the last several years. It's picked up a lot as a trend. If there is any kind of upending of that by the administration, I think that that would be overall good for the U.S. economy because this is white-collar jobs that are coming back. These are people that are able to provide. Maybe we see some more family formation because we've seen Gen Z largely left behind. Many of those respondents in that age group saying, I can't afford a home. I can't afford to have a kid, so I'm not really getting married. I'm not really interested in starting a family. I would love to see that go the other way, be in the interest of everyone everywhere, particularly us here in America, and especially the younger generations, to see that happen. And if we see tech jobs start to come back as a result of some crackdown on that H-1B abuse, then, maybe that becomes more of a trend since we know more of the Gen Z folks are also looking for jobs in tech and other services industries that are peripheral to it. So that's a long way of saying Mag 7 costs for labor could go up in that sort of an outcome, and that could further draw down their earnings growth if that plays out. That's sort of one of those policy risks where it'd be good for the consumer, probably be good for the housing market over a longer duration of time, and it would be good overall for the U.S. economy, but it could put some pressure on tech companies in terms of the cost of bringing on talent, because now you're not, if assuming H-1B visas become a bit more restrictive, not able to just outsource, you have to bring on local talent. So that would be, one thing I would look at. But in terms of this administration's policies elsewhere, I think it's going to be more loose in terms of antitrust and regulatory enforcement, except for where there might be an axe to grind. We know that Trump is not a big fan of Microsoft or Google. We also know that the FTC has opened investigations into both. And so that could continue. We could see scrutiny against Google and Microsoft basically because you could make the argument that they've engaged in anti-competitive behavior. So that would be something that I would look towards, that this isn't an administration that's going to outwardly crack down on some of these very large companies, but where there may be an axe to grind, I think we will see some of that. And I think that is one of the more interesting risks. How do these investigations play out at FTC? Do they get kicked up to DOJ? Do we see any real material antitrust scrutiny? And does it eventually lead to a breakup of Google, where the DOJ has said, if there is to be a breakup, and they're already litigating against Google. So I'll just correct it and say, DOJ has already gone after Google. Microsoft may be on their radar later. But one of the things they've suggested is Google spinning off Chrome, right? The browser that has become the largest, most popular browser on Earth. And if you don't know, Chrome isn't just Chrome. Google's Chromium open source framework also powers other browsers like Microsoft's Edge and Brave. In fact, and even Apple's Safari to some degree has lent more and more into using Chromium. It's not fully adapted to it, but they've definitely borrowed a lot from it. One of the only browsers out there that really isn't based on Chromium is Firefox. And if Chrome is forced to be split up from Google, and Google is basically told, that they can't pay the Mozilla Foundation all this money to keep Google as the default search engine in Firefox, that could actually, curiously, really hurt Firefox. It would actually not benefit the only competition that Chrome has out there, if we're being sincere about sort of how the backends of these browsers are built. So that's a long way of saying that breaking up Google could actually be good for the company. I know that sounds strange, but it would actually allow them to build a broader browser monopoly than what they have now, because it would effectively kill the Mozilla Foundation's largest source of revenue, which is Google buying preferred placement as the default search engine. So that, I would think that also just sort of depending on how any kind of hypothetical breakup of Google goes, I'm not a huge fan of current management. I think they've done okay, but I think they've focused way too much on the bean counter side and way too little on the innovation side. We've seen some leaps and bounds in the quantum computing and also their artificial intelligence. But I feel like if Google was led by someone who is much more tech focused, that could benefit the company. So if they were broken up and leadership shifted around a little bit, I think that could add to some of the dynamism that we had in the older versions of Google, where there were much more skunkworks projects and, much more sort of focus on just basically trying to find edges in new markets. And even with all of the exploration into other markets Google has accomplished, they are still an advertising company. About 90% of their revenue comes from advertising. So it would be interesting to see if they were able to diversify in that sort of hypothetical split scenario as well. In terms of how policies from this administration could trickle down into the broader economy, Ayesha touched on this a little bit during her talk, but I think that it does deserve being reiterated a little bit that some of the focus on tech, which has been a big part of the current administration, could shift over to focusing more on older economy industries. So that deregulation effort could take some of the wind out of the sails of these very large companies who have been beneficiaries of so many different initiatives and start to put it more into some things like manufacturing, which has been in and out of and mostly in a recessionary environment for the industry for the better part of 2 years. So there's definitely, this talk of let's make America great again, bring jobs back home, bring production back home. There could be a multi-year initiative to try to do everything possible to stimulate manufacturing here, and tariffs being discussed as a part of that. But I think that would be only one part of that hypothetical equation. I think that fiscal policy would also shift over to these older economy industries as a part of trying to sort of make the economy more dynamic in the goods side of the equation, where there really is a need for help there. It has been a struggle. This is part of that K-shaped distribution of economic outcomes that we've talked about for about 2 years now, which is this idea that on the top end of the K, you have the services industry. You have big tech, you have the federal government, you have the money center banks, you have the very wealthy people, the sort of top 10 or 20% of society. On the bottom part of the K, you have that older economy, manufacturing sector and some of the other cyclical areas. You have the smaller regional banks, you have the state and local governments, and you have the bottom 50% of consumers, all of whom are not doing as well. And of course, the manufacturing industry fits into that lower end of the K as well. We may see some shift in certain parts of that, particularly, I think, the older economy areas of the market and the manufacturing industry that should be beneficiaries of the policies of the new administration, assuming some of the things that have been talked about on the campaign come to fruition, right? The president doesn't get to just wave a magic wand and bring all these policies into existence. They have to work with the legislature in the House and the Senate to bring these things to bear. And there isn't a consensus as to how all this would be accomplished. We've seen so much gridlock in DC, regardless of the administration, over many years. So I don't necessarily expect that to change. So with all the things that have been said, what actually ends up being done is a whole other matter altogether. So that's another reason why this is a more dynamic period where there is some greater degree of uncertainty, because it's not just what does the new administration want to do, it's what are they able to actually sell as initiatives to lobby groups, which have an outsized influence as to what policies pass into existence, and ultimately to legislators that have their own constituents that they want to serve. And, obviously they're going to be more chomping at the bit for policies that benefit those constituents, and especially those special interest groups, versus those that may not. So it's going to be a matter of seeing what comes to fruition, which is something we'll continue to cover as we get into 2025 and as the year goes on and we start to see these things go through the Congress. Because what's really important to understand about a presidency is they basically have 2 years to get things done. More often than not, in the midterms, the majority loses their majority. And this is just something that's been a trend going back to World War II. Like basically almost every election since then, the majority's lost their majority. So over the next 2 years, and really the first year, because there's this big push to get as much done as you can in the first year, really set the agenda, we'll have a better sense as to what's been discussed and then what has the potential of happening and then what is happening and what impacts it has on the economy, sectors, industries, and various demographics. So hopefully that is a helpful, full-throated answer to your question. You're welcome. So folks, we've been going at it for just over an hour here. We're going to wrap it up here. We want to be mindful of your time as well. Appreciate everyone tuning in. As we wrap up, Ayesha, do you have any final thoughts that you want to share with our audience?
Just that, next year is going to be an unpredictable year. And while we think that equities can still rally, there is reason to remain cautious. As always, we're here, and we're going to try and play this, as efficiently as possible. Um, but bear in mind that it's not going to be, a blanket. We can't give you a blanket statement saying the markets will only go up. Obviously, the path of least resistance is up. And there's a lot of optimism for the market as well in 2025. But bear in mind that that optimism also comes with certain downsides that we've discussed. And we are going to try and navigate it as best as we can. And thank you all for tuning in and listening.
Thank you, everyone. We'll catch you soon. Thanks for tuning in.